Hello, everybody. Thank you for joining us. This is the Traders Exclusive Live Trader Showcase for September. I'm Sherry. If you need me for anything, please email me at support@tradersexclusive.com. And we're so happy you could be here with us. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and strategies. That's also where you're going to find a recording of today's webinar. And of course, we always get started with our disclaimer, where you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. This is teaching and training. Please check it out for yourself. Do your due diligence. Past performance is not necessarily indicative of future result. Moomoo is our sponsor for September. With Moomoo, you get free access to real-time LV2 market data of US stocks. And for a limited time, join 19 million Moomoo users and get up to 16 free stocks, including a Tesla or a Google, when you register for a new account with this link. And you fund it with at least $100. So the way it works out is for the month of September, deposit $100, you get 5 free stocks. If you deposit $1,000, you get the 5 free stocks plus 10 free stocks. And if you want to have a $5,000 account, you get the first 2 tiers plus 1 free share of Tesla or Google.
Okay, welcome everybody. This is the Option Professor, Jim the Option Professor, and I'm giving you a recording on this on Friday, the 18th of August. So the prices that you'll be seeing me refer to as of that date. But my methodology that I'm going to be discussing, I do every day of the week. So it doesn't matter what day of the week it is. This is the methodology that I believe in. This is the methodology I try to teach to people as well. Okay, little background on myself so you get acquainted with me. Again, I don't like to toot my own horn, but here we go. I'm a graduate of Boston College. I took graduate classes over at UCLA, and I started in the business many decades ago. I've been trained at some of the top brokerage firms in the world, been to the Options Institute in Chicago for advanced option trading at the CBOE. I've traded thousands and thousands of option contracts in my career and millions of dollars of stock. So I think what that adds up to is I think I'm qualified to explain, and I passed my registered options principal exam in my career as well. So the bottom line is I think I'm more than qualified to explain this stuff to you, and I'm going to do that today as well. I'm going to be going over how I go about figuring out when it's time to buy and when it's time to sell. I look at things on a longer term basis, intermediate term basis, and short term basis. I think that some of these short term options, even 0 days to expiration, and weekly options, while they are very risky, they're only right for your risk capital. They provide a very interesting alternative to leverage or margin investing. Because again, if you're on the long side of these options with short dated, a lot of times the premiums, time premiums, volatility premiums is very low. And so if you go in the money on these options, you can get a big expansion of premium. And on the risk side, some of these options are going for $1, $2, $3. That should not kill your risk capital pile too bad. And you don't have to be right on every one, because if you do catch the ones that hit volatility, that premium expansion can be much greater than what you've lost on the smaller limited risk options that you might not have won on. So the mathematics, in my view, works very well for this. Now, what's the key? The key is you got to be right. And you have to have some methodology that makes you right. And if you can do that, this can be a very, very valuable part of your asset allocation under the risk capital sector. Okay, I watch all the markets. I watch Bloomberg, Fast Money, all this stuff. I try to get all the information I can. And then basically I come to my own conclusions. After 4 decades, I certainly know how to come to conclusions. But whether it be in the commodity sector or the stock sector or the fixed income sector or the international sector, I follow it all, and I have a pretty good idea of what's going on because I let the charts and the markets tell me what to do. So I am going to let you know now a little bit about how I work. Okay, let's look at the S&P 500. Well, let's start with the fundamentals before we go further. I believe in 3 things. Now, I watch many things, but I come back to 3 things as far as trying to figure out where the markets are going. The first thing is I believe in the relative strength divergence. Why do I do that? Because in my mind, and these are all my opinions, these are my views. I'm not giving you advice today. How could I give you advice? I don't, I haven't met you. I don't know your financial circumstances. So I am just giving my opinions here and sharing them with you. Okay. Now, my opinion is on RSI divergence. It tells me when something is running out of steam. Okay. So that's all that it tells me. How does relative strength exactly work? I always tell people, I'm not exactly sure, even though I've been using it for decades. I haven't really looked it up. All I know is it's kind of like my speedometer on the car. I don't know exactly how that speedometer is working, but I know what 60 miles an hour means, right? So relative strength is very big to me because it tells me momentum and it tells me if it's losing or gaining momentum. Number 2 is the moving averages. Now there's 9 million moving averages out there. All right. So obviously the ones I work with are my favorites. They're the ones I believe in, but there's 9 million of them out there. Okay. And the direction of the moving averages is also very important. Okay. So the first leg on the stool is what? Relative strength divergence. Number 2 is moving averages and the direction of the moving averages and the interconnection of them as well. Number 3 is reversion to the mean. When markets get way away from their moving averages, it's not if they're going to revert to them, it's a matter of when. So when I see something way above its moving average or way under its moving average, I get very interested because I know the setup of reversion is there, and that's a great, great opportunity. But you've got to have other mechanisms to figure out when that reversion is going to happen. Because as many people will tell you, like relative strength can stay high or low for a long period of time. Markets can stay way away from their reversion for a long period of time. So it's very key to have a mechanism to do what? To figure out when that reversion is going to happen. Okay, so I have that in my opinion. I have that, and I'm going to share that with you here today. So that's the basic three-legged bar stool, right? Relative strength, moving averages, reversion to the mean. Okay. Now, am I aware of the Fibonacci numbers? Of course I am. Does it affect me a little bit? Well, I certainly keep an eye on it. Elliott wave, not really into that. Too many waves to count and too many ways to count them. That's just my feeling. Does it have merit? Of course. Robert Prechter, who is, in my view, the godfather of Elliott wave after R.N. Elliott, he did some of the most fantastic calls you'd ever see back in 2020 when he talked about certain things happening and with the Elliott wave. And they all came to pass as far as I could see. He said the interest rates at 0.5% on treasury bonds was a ridiculous low. That $17 trillion of negative yielding debt was something that we'll probably never see again. Okay. And that rates were going to be going up and you were going to get well paid on your savings for a long time. Well, hadn't that been exactly what had happened? So he got that out of the Elliott wave. So on a big macro thing, sometimes Elliott wave is very helpful. And I certainly listen to it, especially when a Prechter starts talking. Now, he also said that the stock market was hitting a major, major top, which it obviously did because we went from 4,800 all the way down to 3,500, right? Okay. Then he was also saying commodities were hitting a big, big low when the CRB index was way down in April of 2020. And we saw oil go all the way up to $131 a barrel, of which he said would happen, but we would not take out the 2008 high. which helped me figure out that when we got up to 131, it was time to sell the heck out of oil because it was very close to the 147. And the stuff that I was doing was indicating it was tapped out. So that was very helpful. And of course, the price of gold went up as well. And the grains went from $8 a bushel on soybeans up to 15 or 17. So again, I don't dismiss anything, but I rely on my stuff when I make my final decision. But again, I have a very open mind and I'm very unprejudiced. You know, I don't get linked into one side of the market or the other. I think that's quite dangerous to do. So that's basically the foundation of what I'm going to talk to you about today. And again, let's start out by looking at the S&P 500. Again, we're looking at prices here on August the 18th. All right, so let's take a look at where I saw here. Okay, why did I think that this market, and I agreed with Prechter, that this market was going to come down back in 2021, 22? Well, we made a high point here in, and you can see on your screen, we made a high point here in November 2021, 47.40 with an RSI of 72. The next month, December, we go up and make a new high up to 4,800 almost, and we have an RSI of 74.88. Then we make another high, and it says 65. So we made a higher high with a divergence on the RSI. That tells me it's tapped out. When you find out or think it's tapped out, then you go to the shorter term charts to get your entry points. Okay, I'll get into that in a second. But can you see it was an obvious reversion to the mean situation? So when it's up at 4,800 and I'm telling people this thing could revert to the mean back to 37.40, people look at you like you've got crazy heads, because look at all that money they were making after the crash when the Federal Reserve Treasury printed 21% increase or 25% increase in M2. That's called juicing up assets, right? And they juiced it up so much that we had 9% inflation, right? So the bottom line is that reversion was, this gives me where I think it might go to. You get it? Now, obviously that blue line is rising. So it never told you that the trend was down. Only the red got that. Okay. This told you that anything around here, oh, we got an update on the chart here. Okay. And the update, the, what do you call it? The rise here, again, got back on its bicycle right as soon as it got about 3,800 again. When the market, here's a tip on the moving averages. Just because they're being penetrated does not mean that these are called, I call them Fugazi dips, where they try to dip it under the averages. They're there for just one little bit of time, and then they're right back above it. Well, look at over here, the crash. See, this is why I use moving averages. Down here, people were panicking like the world was coming to an end. Now, we knew that Powell was printing money. He set up 14 facilities to buy everything that was not tied down, right? Him and Mnuchin, right? They're opening and they're buying all kinds of garbage, right? To stabilize things. But not only were doing that, it was hitting the long-term average here that I use. So I knew that this would be a time not to sell, but to defend. If anything, buy the heck out of it. And if it gets under here, then maybe get out, right? So these things are helpful to give you peace of mind or maybe make you not panic. Now, once you got back above the blue line here, you were back in the pink. And once you got above red, it went all the way up to here before. So you could ride these waves pretty good. Forget about Elliott wave, just ride the moving average. Okay. Now, here, what about now? Now we went up to this 4,600 and people were wondering why I'm saying this is a sell zone. Why you should be dumping, trimming, using replacement trades or hedges like collars or married puts. Why was I saying that? Watch. On RSI, there are certain numbers that I believe are important. Okay, you want to know what they are? Here they are. 50. If you're above 50, you're in a generally uptrending market. Under 50, you're generally in a downtrending market. Okay, that's a big number. The other number is 60 and 40. Why 60 and 40? Because once you get through 60, sometimes you're going to get into an acceleration phase where the market's really going to take off, and it could go into the 70s or 80s. Okay, when you come back down off of a 70 or 80, 60 should be a support. If it goes through 60, that could mean that that whole up move is over and you're going to start going into a different downtrend. Okay. Same thing at 40. If you go under 40, there's a possibility of accelerating to the downside. And if it gets way under 40 and comes back up, that 40 area is also resistance as well. So having said that, where are we on these things? In July, we went up to 46.34 and the RSI was 55 here, right? And then next to us here, we went to 40, the high in August so far has been 46.21 and the RSI is 55. Can you see it has not been able to break above 60? In fact, the high, when it was on the high, I think was only about 58 or so, or 60. So it can't get through 60. That tells me that it is possibly at a resistance point. Then I went to the shorter term chart to get some confirmation that that was true. So I go to my 1 year graph. Now my 1 year graph, by the way, notice that the red line is primarily rising the whole time, and all these little violations you see, like there and there, those are called Fugazi dips, meaning if they only dip it for a little bit and get right back above it, that means that the trend is still going your way. This trend rolled over at about 45.84. So this thing has told you get out, get short ever since that time. And that has been working out well. And now you can see it's coming into the purple line. Now I'm doing this on when? August the what? August the 18th. Okay, you'll be seeing this broadcast afterwards. So I'm saying that right now, the lows could be coming in at 43.40 area. They may dip it through for a short time and then get right back above it. So this neighborhood here, I would watch like a hawk, because if they take it out, now we're at the 43.57 on my screen, so that's another 17 points. But if they do go through there, that could be an area of support, kind of like it was down here in May of 2023, right? And April. But what if it does break through there? Where could it possibly go? Then I go to my 5 year graph and I see that you've got the 5 year support down at 42.79 and then 41.85 and then 40.70. So that's somewhere in the lows could come in somewhere in the neighborhood of the 200-day moving average if they hit it harder. So again, my feeling at this point is obviously you should already be sold or done. So I don't like to do things when it's not the right time. So I don't know if it's the right time or not now because it's already made its move. So this is not the optimum time for me to do anything. So the bottom line is that, it's either going to hold here, in my opinion, at the 43.40 area, or it's going to go into a deeper dunk. Okay. And a deeper dunk would take you into these other areas. And what are those other areas again? 42.80, 41.80, 40.80. Okay. So that's the way it looks right now on the S&P 500. But again, we have been, obviously in the liquidation department ever since way up here. And again, let's show the RSI divergence. You got what? 73. And up here, you've got what? 62. That's a divergence. It's running out of steam. It's had a big run. All these people that are long, they're going to take profit at some point. Who's going to buy up here? The RSI is telling you the volume's drying up, right? So that's the story there. All right. So basically now, again, when and if you do get a turn, let's take a look at the monthly graph. And again, if you're looking at a monthly or a 5-day, you can look at a 5-day here. I mean, you could be doing short dated puts as soon as it started dropping here under 45.11, short dated put. It rallies back up, buy more short dated puts. Okay. Play the trend. Some of these days here, this is a 1-day deal. I'm sure a 0 days to expiration would have worked pretty good here, right? So that's why we use the short-term graphs for this kind of thing. And again, remembering, you're looking at, pretty cheaper premiums when you don't have much time on them. So again, a lot of people trade the futures, right? And the E-minis. There you got what? You've got leverage. and you've got possible surprises that can happen, particularly on overnight, right? So, if you're short the market and it goes up 50 points overnight, you're going to get whacked pretty hard on that leverage futures contract. If you bought a put that had a few days to go and you paid $2, you're off $200 and you go on your merry way and you reassess and find something else. So that's the advantage, in my view, after decades of doing this as a speculative tool. There's no question in my mind that these things have merit for people who want to speculate with their risk capital. Again, limited risk, leverage, and volatility. That's the trifecta, right? So that's why I think these things have merit. But your timing better be good, because if it's wrong, like, say you thought it was going to bounce up here and you bought a call with a week to go. Well, you went against the trend. You're right in the soup. You lose all your premium. If I start buying puts down here, after this thing has dropped like this, then, this thing is obviously going to be prone to possibly a little bit of a rebound next week. So if I bought a weekly put down here and it rebounds next week, you're going to lose your money. So you got to have your timing down like a razor blade. And that's why I use the stuff that I use. So again, and when the moving average is pointing down, that's when you're going to probably get a more substantial move. When the moving average is pointing up, like this thing is not really pointing up, it's pointing up a little bit. Well, you got a decent move here. I mean, you got enough to make some money. That's a 20-point move, right? But the point being is when it looks up like this, up, then you have a more probable chance of getting a decent move. When it's going up and down a little bit like this, that's choppy. And that's one of the problems with moving averages. You're not looking at, the holy grail here. That's why these limited risk options are very good, because if you're wrong here, let's say you got chopped up a little bit here and you went through $5 or $6 of premium. Well, once you got into a ride like this, that $6 of premium could be made up. So again, that's why money management is very, very important. And to be honest with you, I'm from the school of less positions, more volatility. Meaning what? Meaning, you don't have to put a zillion positions on. Put a smaller amount on and let the market make you the money. In other words, rather than trying to put in, like when it's choppy here, putting on 10 and 20 and 30 and 40 lots or whatever you're doing, if you're working with one lot or two lots or whatever, yeah, you're getting chopped up here, but just one lot will take you on a very nice ride. You see? So, your positioning or I forget what they call it off the top of my head, the amount of contracts you use, your money management. It's a key. It's a key, because no methodology is going to be right all the time. And if you plan on it being right all the time, you're in very big trouble. Okay, so at any rate, that gives you a little bit of an idea on how we've been seeing the S&P 500. I'm going to now go over the Qs. Then we'll go over some of the popular stocks. Okay, on the QQQ, again, I like to start out everything with the big picture. Big picture is called the 20-year graph. Okay, now the 20-year graph, here is obviously going to be very similar, because these stocks in the S&P are also in the those big seven. They're in both indexes, so don't be shocked when they go the same way. Obviously, they go at a faster speed sometimes. Okay, now here's the deal. You have a high point here in 2021 of 77, and then you go down and you hit another one, 77, and then the next time it hits 64, that tells you it ran out of steam. Okay, now it rolls over here, and it rolled over at around 360. Had a nice little drop down to 260. And when it hits 260, I've got a low on the RSI of 42. I got a low here of 44. That's a divergence. That's telling me it's run out of steam on the downside. Now we get back above 313. That tells me we're back on the bicycle, and we go all the way up here. And we go up here, look at the RSI. Now these numbers I talk about, 60, 40, they're not to the penny. Sometimes the RSI might go through 60 a little bit, but if it goes right back under it, that's not a good thing. So let's, and like on the 40 number, it could go through it a little bit, but if it goes right back above it, again, that still validates that number. So I say right around 60 is resistance. Here it's at 64. But if the next month's at 57, that tells me that what? That this thing is weakening. Why? Because it cannot stay above 60. Now, if it gets back above 60 and stays there and looks like it's going to go, you could have a blow off top up to 420 or higher. Okay. So like I say, I'm not on one side of the market or the other. I'm trying to get on the right side of whatever it is. So right now, again, this told me that it might be rolling over a bit. That makes me go to the 1 year graph. And there you go. You have a high point here on the RSI of 76. The next high is 76. And then this one over here comes in at 65. So it's losing speed. And then it got under here at 380. There's your sell at 380. So you should be selling this thing. Where could it go down to? It could go down as low as where? 345. I find these to be attractors. Notice it kind of held it around here too. So again, that's where it'd be my target if it's going to keep going. Okay. Again, it's getting a bit on the oversold area. Let's see what the RSI is doing here. 38, and now you're what? 32. That's not good. It's comfortably under 40. And when you're comfortably under 50, that's not good. When you're comfortably under 40, it's really not good. But as we come down here, I'll be looking for a divergence on RSI. I'll be looking to trade against that number if it happens. So, again, you've got the power of time here. I'm talking on August 18th. You're going to be looking at this afterwards. But that's how I see it now. Certainly, this is where you want to be doing your business, not in the middle of nowhere. You want to do your business in the middle of nowhere? Good luck to you. Have at it. That's not me. You want to do it? Good luck. Could you luck? Don't forget what happens. Luck always runs out, right? I'm not interested in luck. Okay, so there you go with the NASDAQ. And then if you look at the monthly, this thing basically gave you a get out of town up here. Again, in that 380 area, 383. So you had a nice little ride. Again, what did I say? If it gets violated, but the thing is still pointing down, these are Fugazi prices, and then they never broke the blue and not much of the green. Okay. So again, that's not a bad move. That's not a bad move. Now, if we were to break under this number here, for whatever reason, 345, what does the 5 year graph tell us the next levels are? Next levels are going to be 343. If we break, that's right in that 345 neighborhood. Next numbers are 324 and 316. So if the wheels come off a little bit here, China, as of this writing, seems like it's kind of getting a little wild, telling their people not to sell, telling the banks what to do. It sounds like they're trying to communize the free outcry of the markets. So I don't know how that's going to keep going, but at any rate, that gives me an idea where things could go. Now, here's the other thing about the 5 year, very important. That 5 year hasn't rolled over yet. So if this thing starts closing above 367 for whatever reason, I'll be changing my tune. Okay, but that would be a good line in the sand, 367. So there you got some parameters to work with. Yeah, we're at 355 right now. Downside 345 or underneath 345 area, you're talking 320. I don't know where the 200-day average is, but I'm sure it's down there somewhere. So it could go down there if it gets real sloppy. Okay. If this is just a little pullback and we're in this roaring Tom Lee bull market where we're going to all kinds of prices up there, we've got to get above 367, and then maybe I'll start listening to Tom Lee. Right now, again, people that were bullish, they got fortunate on two things. As we went into this year, right, we were very short the market, right? Positioning, short tech, short the market. Everybody's out. So that is a setup for a big rally. Why? Because the economy and labor never cracked. And when you're selling it off like this, you're talking recession. Now, what did we get this year? We got inflation backing off a bit, although that's debatable. And then we got what? Because we got higher interest rates, so that wasn't any helpful. But we did get the AI tech boom, right? And then we got people playing FOMO, fear of missing out. And that set up another reversion to the mean, which is what we're doing right now. We're reverting to the mean. Okay. Now, again, this market is primarily looking like an up market right now. So I'm not saying we couldn't see higher markets next year and later in the year or whatever. But as I've been telling people, the time frame of August to October is always a dangerous time. So if you have a dangerous time and you are way up there and the RSI is running out of steam and you see the market starting to slip underneath moving averages, you'd be crazy not to bet on the downside, right? And so this is an after the fact deal, though. This is where you want to do your business. That's the key. If you want to do buying, I would probably be waiting to see if we can get that number down here, unless what? So here's the deal. I'm either going to look at this stuff if it goes down to 345 and see if it holds, or if it gets back above 367, I'm going to say the pullback's over and time to get on board. So I have parameters. If you don't have parameters, what are you? You're walking around in the dark, in my view. Okay, so there's your NASDAQ. All right, here's the other one that's telling us that it doesn't look very good looking down the road. And this is your Russell. Now, everybody was running into the Russell because why? We're broadening out. We're broadening out the rally. The Russell's now participating. Get into your small caps. Get into your mid caps. That was the pitch about a month ago, right? And it looked like it might be happening. Right now, it's hanging on for dear life. So it may still be happening, but I don't like some of the stuff I'm seeing here. First of all, again, you got above the blue line, but you didn't hold. So you know what? You want to get me back into the Russell? You start closing this baby above 195. Okay? You get it above 195, that opens the door to all this lovely area up here. If you can't get above 195, you're not going to see that movie. Okay? And if it gets above 195, that means it will have held the 180 area, which is very important. And it took off the table a move down to this 155 area. So let's tell you again, I'm sharing my opinions and my views. Everyone's got their own, right? My view on this is this. These things do have lower valuations. These things will benefit if our economy really does get going in 2024. And it obviously is going very good now. But is that what the Fed's trying to do? Is the Fed trying to get the real estate to just keep going? Again, because if they can't crack real estate, they can't get that owner's equivalent rent down. And they got the mortgage moving towards 8%. If you don't think they're trying to get that real estate to come down, you're out of your mind, right? But it hasn't happened because everybody who's got a 3% mortgage ain't moving. And that means the supply is not there. And you've got constantly people out there who want to get out of their parents' house, right? And you got a lot of people out there who, just are going to throw in the towel on waiting for a dip in the real estate. They want to get a house. And they've made money on their houses. So maybe they want to use it as an investment because that's something that's kind of solid that they've made money on. And they can rent it out and create cash flow. There's a lot of reasons why, that real estate's not cracking. Now, will it ultimately crack? I never forget what Buffett says. Interest rates are like gravity to investments, meaning the cost of money wears you out. It wears out valuations. We're at over 20 times on PE ratio on the S&P, and on the NASDAQ, I think it's up towards 25, 30. So we got high valuations and we got a high interest rate environment. That doesn't make any sense. Things that don't make sense don't last. We've got almost an 8% mortgage. Mortgages have almost more than doubled, which means your house payments have more than doubled. We haven't seen any cracks in real estate. That doesn't make any sense. Things that don't make sense don't last. That's my view. So, will those things ultimately happen? Well, I think they could. And these problems of deflation and stuff like that that's going on over in China, that could be exported to us for all we know. All right. So again, on the Russell, I understand the story. I think it could have merit once everything gets back on the bicycle. Here, I see the bicycle at what? I see the bicycle at above 195. I see the support right now, basically where we're at. So it could hold down here. Now I go to the 5-year graph and see what it tells me. And by the way, the RSI here, does look like it's trying to roll over. It's under 50. So we really want, if you're bullish, you want this thing to hold right around here. Okay, on the 5-year graph, again, it's under the purple line. You see how the purple line is going back through it, back through it. That's kind of like, in my view, a barometer. And so the barometer right now is where? At 186. So we start closing above 186, and then we close above 195. And well, let's put it that 186 to 190, closing above that zone, very positive. Closing above 195 and then 200, you're off to the races. If you start closing under 180, you can see that would not be good. And so where would it go if it breaks under 180? Then I go to the purple line here, and the purple line tells me it has downside potential towards 155. So if the wheels come off, that's what you're looking at. If they don't come off, 180 should hold. And if it does hold, you got 190, and then you got 195, and then you could be right back on the bicycle. Okay. The 1-year graph, did that tell me anything? It told me to get the heck out of this stuff at 196. Let's talk about divergence. 64, 58, 66, and then back to 57. Again, another example of it breaks through 60 and gives you a Fugazi breakout. And by the way, Russell is famous for this. Let me show you something on that. This is one of the worst things I ever saw in my career. This thing had resistance, RSI, having a hard time in that mid 60s. And then all of a sudden it goes way up here. RSI still can't get going. They blew out all those stops, the people that were short up here, or anybody who was buy stopping to get into the market on a new high. And look what they did. They brought it to 240, and that was gotcha, and then boom. See, that's why when these averages are not really turned up and you get this kind of a move, think of it as a Fugazi. Fugazi means a fraud, okay? Okay, so that is a fraudulent move. And then once it got back under 220, boy, that would have told you, whatever I did up here, I better ditch, because this thing is back in the soup. So that's an example of, why you have to be careful when they make these breakouts sometimes. So anyway, getting back to the 1 year, you can see that's what it looks like here. It broke under purple, so that's not good. And so getting back above 185 is very, very important right now. So let's see how that works and see what happens there. Okay. All right. And then basically, what else can you do here? Let's see. On the 1 month. Okay, on the 1 month again. And you can see here, you went down to 23 and now you're at 22. So there's no real divergence there. So bottom line is, on a very short-term basis, it looks like it could be a candidate for reversion to the mean. Very short term, like next week, you could get a bounce. But here, and again, let's see what here, you got 30 and then you're at 30. So, a big new low and not a big new low on the RSI. So again, it could try to get back above 186 next week. It could. Again, on a 5-day basis, very, very down, very much down. Again, reversion to the mean. So if it does go back up, where there's going to be resistance, right? On a 1-day graph, not too little data to work with. Okay, but that's the story on your small caps. Let's look at some of the different stocks out there, because we've been very, very, very good at giving people what I consider to be very sound input. Okay, so our input, our insight, I think has had value. Let me show you. Like I say, we don't not like companies. We don't not like things or like things. We're just trying to be right side of the market. That's all. So Apple is a great company, right? Great, great company. But even great companies come and go and have their times, right? So here, Apple on the 20-year graph. This is a poster child for reversion to the mean. Poster child. Okay. So now I'm looking for divergence. 73, go up here, 66. You run out of steam. Now I go to the 1 year. Broke under the purple. So getting back above 175 is going to be very important next week, or else there's further downside towards where? Further downside toward 164. And if the wheels come off, 150. Where do we say this thing is going back up? Well, you got to at least go back above 185. But again, you know, this thing's pretty clear. Get the heck out of 195. And you had the divergence up here too, 77, 70, 63. You know, I don't need a weatherman to tell me which way the wind blows, right? So that's the story on Apple. Wasn't bad to listen to us on that one, huh? Okay, what about Microsoft? These are great companies. You realize how bullish people are on Apple at 200 and how you sound like a moron when you say this thing is overbought, it's running out of steam, and it's going to have a drop? People think you have three heads when you talk like that. Now, this thing is right into it here. Let's go to the 20-year on Microsoft. And again, your high point is 81, your high point is 65. Running out of steam, Fugazi, Fugazi, and reversion to the mean. Okay. And now it's right on the thing. So obviously, if you want a point to defend against, it's 312. And notice today's low is 312. So if you see it bouncing off 312, you were told on August 18th that it could do that, right? Right. Okay, so again, though, it gave you the sell up here well above 340. And if you looked at the 1 month graph, it gave you pretty good sells up here at 355. And the average never really turned up, right? Never really turned up, and it's still down. So if it pops up towards 320 or 323, it's going to be there against resistance. If it really had some big surprising rally, 330 could be an outside chance. Okay, so there you go. It again, where if it breaks under this neighborhood, right? You remember we're on the support right now. If it breaks under this neighborhood, where's it going? If the wheels come off, this thing can go down towards 314. Excuse me, it's at 340. It could go down to 290, or it could go down to 272 if the wheels fall off. Okay. And again, when you get this high on a divergence like that, the wheels can fall off. The wheels can fall off. I mean, I'm not bearish when it's going up. I'm not bearish when it's making when the RSI goes above 60. Remember, I told you it's going to have an acceleration phase, right? Well, here's 60 at 280. Now it goes above 60. It goes to 64. Goes to 60. 68. Goes to 70. Goes to 70. And then it starts running out of steam back to 65. So, I'm not fighting the tape. Okay, I'm not fighting the tape. I'm too old to fight the tape. All right. So there you go with a couple of big guys here. NVIDIA's coming out next week. I have no idea what their earnings are going to be. Let's see what the chart's saying. Well, I'll tell you a stock here that might give you a tip. I guess this company, SMCA, hold on. I guess this company does a lot of business with NVIDIA, and so there's some connection there. And the chart looks the same, right? So this would make me concerned about NVIDIA, among other things. Now, again, NVIDIA is already coming down, so it's coming in with a lower bar. So, this thing was up here when their earnings were announced. And when their earnings were announced, they were fabulous. I think they were 70% increase on revenue, right? Great. But when you go up like this, you got to walk on water. And if you don't walk on water, what's going to happen? What's going to happen is you are going to find that people will buy the rumor, sell the fact. And that's what happened here. Again, we also had RSI at 79, and then we had 83, and then we have 83, and then on this big top, we're at 59. So once this thing happened, obviously that was party over. And again, where did it go back towards? It went back towards the average, right? And it's kind of trying to stabilize a little bit here, but now it's got potential of going down there. Let's look at the 1 year graph. Yeah, again, you got to get out of town on the breakdown. But again, when your RSI is at 76, 75, and up here, the RSI is 73, and over here, the RSI is 72, you're not getting 76 here and 73 there. That's a divergence. And when you're that far away from its moving averages, I view that as a pretty decent signal. Again, if you do a limited risk short-term put, you can only lose the premium. So you're going to be taking shots. That's what buying puts for a week to go or on a daily trade. They're shots. They're speculative gambles. And speculative gambles can go to zero and you can lose your money. they can also pay off big time. So that's why money management and being patient and waiting for the right time to hit them is extremely important. And this was the time where you had a big move up, and you got your little divergence there. And if you wanted to take a shot at a put, it's at 360, and if you did a little bit out of the money at 340, you might have been able to get in there for a reasonable amount. And within a very short time, it was down in the money here. If it's at 360, you did 340 or 320, you just want to buy a cheapie as a gamble. Well, then basically you got a nice big drop on that thing in a very short time. So that's when these things make sense, the little turning points, right? Okay, and sometimes they're false. Here you got a turning point, and it didn't give you that much, of a move. Probably enough to come out with some money, but again, it didn't follow through. Okay, but this gave you a divergence as well. You see the high is 90 there, and you see the high there is 82. All right, so anyway, now let's get back to NVIDIA. NVIDIA is I'm sure the guys who trade NVIDIA are very familiar with the chart I just showed you. And that's probably why they've been selling it off. Because they're saying, hey, listen, if NVIDIA does not come out with a blowout, because this is the Cadillac of the whole thing. According to what I hear and read, this is the company that has all the chips that you need, 80% of the market. They have everything. They got graphics, they got data centers, they got, all of it. I'm not an expert in this stuff. I just, got bits and pieces of information, but I do understand bottom line. Bottom line is this is the Cadillac in this whole AI thing. And supposedly they got the corner on all the chips. Basically, that's what I understand. That's why the stock has done what? Let's take a look at a 5-year graph. Well, let's look at a 20-year graph. That's even more ridiculous. Okay, this is the poster child of a reversion to the mean. So you understand when you see something like this or this, you gotta be starting to price out a reversion trade. Okay, all right. So now we are going over here and we are going to the 5-year graph. Now the 5-year graph up here, again, reversion to the mean, and it came at least down to the average here. So that's where it's trading. You notice it's trading at 417 and we're at 426 on the 12 SMA. Now, if it breaks that, obviously 350 is in the cards. And that would be against the high over here. So is that possible? It's possible. Okay. Let's talk about the 1 year. Now, the 1 year, if they come out, because again, this could be kind of a Fibonacci pullback here. Let's take a look. Because again, I'm doing this before they announced earnings. Again, with the red line pointing down, I would say that there's more of a risk of going down towards that 350, 360 than going through the roof. But it could do it because here's the low at about 400. Let's do, as they call, rough math. The high here is what? The high there is 438. No, the high there is 452. Rough math. It pulled back to about 400. That's a 52-point drop. 61.8% gives me 32 bucks. So from 452, that's 52 bucks, 61.8. That gives me 32 bucks. 452 minus 32 bucks gives me 420. Can you see 420 is where it's kind of pulled back to? The low's been 422. Well, actually 418. Okay, so it's down 15. So it's right around that Fibonacci pullback. If you can hold here, then you can make a Fibonacci story out of a pullback. And then if it blows out the high there of 452, then, people are saying 550 on this thing. Well, if they really have cornered the market and the demand on this stuff is what they say, and they announce their earnings are tremendous and their guidance is off the charts, then again, this thing could take off. If it gets above 452, it could blow out the highs. Okay. Now, we'll have to see what the RSIs look like if it does that. If there's a big divergence on the RSIs as it blows out the highs, it could be a Fugazi rally. So I'd be monitoring that. So if the red line is telling us anything, then this thing could break down. And again, the 360 area, which would be halfway into this gap as well, that's what you'd have to plan on if this thing doesn't get the numbers that it needs. If it blows out people now have sold. It's gone from 480. Now, by the way, this was a great short as well. You had 72 up there, and then you're at 72. If you make a $40 run, a 10% jump in price, and RSI can't move at all, that's not a good sign. And then it stays there, and look where it goes to 56. So it pulls back to the red line, comes back up, and it only goes to 61. Remember I told you if it breaks under 60, that 60 could be resistance on the way back up, right? Okay, so now I think this is a resistance zone. This tells me to get on the sell side at 458, and I got a $40 drop here. Bounces back up, can't get above the green, and now it's back in the soup underneath the red, okay? But this is a dangerous stock to be messing with because, again, if they can come up with the numbers that everyone is saying it's going to, it could gap to the upside. Again, the way the trends look right now and the way things are going, that is not something that would be kind of a against what's happening type deal. But that's the story on NVIDIA. You want it to hold this 420 neighborhood. And if it does, you got a Fibonacci pullback of this move there. And if they get good earnings and they break above 452, it could obviously gap up pretty well. But again, a gap up that doesn't take out 480 and then shows a divergence would be another selling opportunity. Again, this thing does still look like a poster child for a reversion to the mean. Okay. But again, I have humility. If you don't have humility, if you lose your humility, you're going to lose your money. So, you always remain humble on everything you do. Okay. Now let's quickly go through a couple of different of the commodities out there. And I'm going to start out with this index here. This is the Goldman Sachs Commodity Index. Okay, here's the story here, guys, because this is a big story. Okay, remember I told you about Prechter and his call? Well, this was his call saying there was a cyclical or whatever, generational or something low in commodities here. Was that correct? You bet it was, okay? And we got a big run. And he said before it had its big run that it could go up in this neighborhood but not take out the 2008. So that's exactly what happened. And now when it's up here, I'm looking for a reversion to the mean. You understand? I'm not looking to buy up there. I'm looking for a reversion to the mean. So when it made this high up here with a 75 RSI and then had a retest and it was 67, that was enough for me to start looking at the shorter term graphs on energy and start thinking there was coming down. Okay. So this thing is about half energy and the other half is primarily grain and metal. So that's the constitution. Now, when I tell people it's at 850 and it's going to come back to the mean, which is down here, people obviously think you have three heads. Okay, but that's what happens in life. They revert to the mean. Now the blue line is rising and it's back above it. This is bullish. Bullish for grain, bullish for gold, bullish for energy, right? Now, if you notice, John Deere announced their earnings this week, and they not only beat earnings, but they increased their guidance. So, and again, food is a big thing. Everybody needs it. Energy is a big thing. Everybody needs it. And the way currencies are printed, and industrial metals like infrastructure, people need it. So the bottom line is that tangible assets, and interest on your money are the two themes right now. People like to have tangible things. That's why the real estate's doing so well. Tangible things, and they also like to get high interest on their savings. That's why people are gravitating to get that money market at 5.25, as long as it lasts. Now, again, what's this telling me? It's telling me, first of all, our first buy signal was the move above 550. Our next buy signal is when it closes above 600. When and if. Because if it doesn't do that and it gets back above the red line here, which is at 586, which it is under right now, this thing could go back into the soup. And it could go down and test 550, or it could go back into a bear market. So again, I'm saying there's potential here for a big move in energy, a potential. And where would it go? Well, on the 5-year graph, I see a gap. And I see the gap here right there between 700 and about 705. So if this thing wanted to go up and fill the gap, if it breaks above 600, that's where it could go. If it does go up there, and you see it's holding the purple line comes in at 578. So it's crunch time for the commodities right here. If it starts breaking under 578, if it starts breaking under 550, this is a Fugazi move, a fraud, and it's going to go right back into the soup. So again, if you think oil's going to, and I've told people this already, oil's got a line in the sand right now at about 85 bucks. If we can get above 85 bucks, it opens the door for 100 bucks. If it can't get above 85, this is a rally that's going to fail. And we already noticed gold has not been able to get above 1980. And we also have noticed that the grain is having a hard time getting above $15 on the soybeans. So it is possible that deflation is going to come in here and it's going to cause some of these, the high interest rates, as Buffett has said, is gravity towards assets because it's the cost of money. Gravity ultimately will prevail in my view. So again, unless we get some relief on that, that's going to be a tough thing to get prices to keep going up. Okay. But here again, it does look like it's trying to make a turn. It made the first move above 550. You see where I'm getting 550 from. So if we get under 550, I think all bets will be off, particularly if all these things could keep turning down. And if you blew out here, this looks like the abyss, but it's not the abyss because if it blows out there, you could stop at 500. And that's the high here. So if this is something where they've sucked you in on energy, they've sucked you in on some of the tangibles, and then they tank it underneath the 550, the net really could be down here. And so if this RSI is at 44 and the RSI right now is at 49, if we went down here and the RSI held 40, I'd be very interested down here. But again, right now you need this thing above 600. And let's go over the stuff that you have in here real quick because I got to close up. It's time for me to close up. Crude oil. Again, what I tell you here, first of all, you see why this is called reversion to the mean up here. Remember I told you, if you tell people it's going to pull back to the mean, they think you're out of your mind, right? See, same thing. Crude oil and the Goldman Sachs Commodity Index, pretty much the same. It's making a rally up here. It's got a hold in here. What does in here mean? It means 75 bucks. You don't want this thing under 75 bucks. And can you see the high here has been 84, 83, okay, 84, 89. That's what I'm saying. You start closing above 85 and you get that Goldman Sachs above 600, you're going to possibly be off to the races. Okay. Let me give you the gold real quick and then I got to shut her down. Okay, gold, again, you had a divergence here. That's why you're pulling back. It's got to hold this 1840 neighborhood, but I want it to close above 2000 to get the thing on the bicycle. And if you can see here, get above 1950, get above 1980, get the red line pointing up, and I'll be much more interested in gold. Again, above 1980, get these things moving up. The first thing is you got to get this 1947. So I said 1950, 1950, 1980, hold it up there, get these things moving up, and gold could blow out 2000 and get going. Other than that, you've been holding a falling knife, and that's very painful. All right, it's time for me to wrap up. So I'm going to tell you exactly what I got for you here. I hope after listening to me here, you know I have a pretty good idea of what's going on, and I have a pretty disciplined methodology of figuring it out. So if you'd like to get more information on how I do this and maybe talk about other things as well, I've got a free trial offer. The free trial offer will go over markets that you're interested in. We'll analyze those. We also have some PDF reports that give you printed information on the best stocks by sector, meaning if a sector gets hot, these are the stocks that should be good. It's a great reference guide. We also give you option information on trading the short dated options and how to trade them and what strategies, how they work, and a lot of information on different strategies like that as well. Very helpful, very insightful, and you get a free trial. So again, all you need to do is email me at optionprofessor, OPTION, professor, PROFESSOR, @gmail.com. and then I'll get you the information. Just include your email, obviously, when you email me, but also a contact phone so I can speak to you directly. And you'd be speaking to me directly, not some guy down the street or whatever, like, you call people up and you're in some kind of a phone bank. That's not the way it works. You talk directly to me. Again, I've been doing this a long time. I'm trying to share my opinions and my insights to help people and educate you on not only how to trade the options, which strategies and that kind of thing, strike price selection, expiration selection, that kind of thing, but also obviously things that'll help you with your market timing. Okay, thank you very much for listening. I hope I added some value to your day. Good luck and good trading. I am on my way now on a vacation to Martha's Vineyard and then over to France, Corsica, and Sardinia. So I'll be back on September 16th. Until then, have a good luck and good trading. Shoot me an email so when I come back, we can get together. Have a great day, everybody, and thanks for listening.
Moomoo is our sponsor for September. With Moomoo, you get free access to real-time LV2 market data of US stocks. And for a limited time, join 19 million Moomoo users and get up to 16 free stocks, including Tesla or Google, when you register for a new account with this link. And you fund it with at least $100. So the way it works out is for the month of September, deposit $100, you get 5 free stocks. If you deposit $1,000, you get the 5 free stocks plus 10 free stocks. And if you want to have a $5,000 account, you get the first 2 tiers plus 1 free share of Tesla or Google.